Today, I'm going to discuss the reasons why you should sell a stock. I'll be pulling from the wisdom of Warren Buffett and Charlie Munger to help answer that question. Aside from that, I'll provide an update on my long-term dividend stock portfolio and explain all my new transactions over the month of July. Let's roll the intro. My name is Zach, and you should leave a like and subscribe to the channel if you enjoy the video. Before we start, I'd like to remind everyone that you can join a community Discord server and see my entire portfolio if you support over on Patreon, a link in the description. Since May 2020, I've gone from $32,939 to $64,032 invested. My current dividend yield on cost is 4.21%, and my compounded yield, which takes into effect reinvested dividends, is 4.39%. The differential between the dividend yield and compounded dividend yield increased 0.18%. This stat acts as a measurement of the snowball effect from dividend reinvestment. In this next chart, you can see how the value of my dividend portfolio has changed over time. My current value is $84,153.52. This has continued to rise with the market, which is nice, but remember, value is volatile, and the main goal of this portfolio is to build a source of growing earnings and dividend income for the long term. In this next chart, you can see my earned dividends to date. In July, I earned $187.61 in dividend income. My three largest payouts were $56.22 from MO, $48.19 from KMB, and $45.48 from FRT. I reinvest these dividends to increase my future dividend payouts, adding to the snowball effect. Here you can see my cost allocation by sector. Communication services is my largest at 27.4%, followed by consumer defensive at 23.4%, technology at 13.7%, energy at 13.6%, and healthcare at 7%. The increases in communication services and healthcare are due to my recent buys. I purchased 10 shares of Disney at an average cost of $171.78. I bought 70 shares of AT&T at an average cost of $28.01, giving me a 7.43% dividend yield on cost. I bought 5 shares of Altria Group at $46.24, giving me a 7.44% yield on cost. Finally, I bought 60 shares of Walgreens Boots Alliance at an average cost of $45.97, giving me a 4.16% yield on cost. I recently made a stock review on this company, so check that out if you want to hear my in-depth analysis and thoughts on this purchase. I've made stock review videos on all these companies, so be sure to watch those for more context. I sold 3 stocks during July: Kraft Heinz, Pfizer, and Welltower. I made a sizable profit on all of them. In total, these investments had a cost of $2,785.67, and I profited $1,663.93. This was a 59.73% total return. These transactions gave me $4,449.60 to reinvest into the stocks I mentioned earlier. Now, we focus on long-term investing on this channel, and it can be hard to recognize when to sell a stock. So before I give my reasons, let's hear what Warren Buffett and Charlie Munger have to say on the matter.
The sell situation has changed over the years, because when I started out, I had way more ideas than money. I mean, I would go through Moody's manual. I went through it page by page, and then I went through it again page by page. And I found stocks in there that I could understand that were selling at like 2 times earnings, even 1 times earnings. Well, when you only have $10,000, that can get a little frustrating. And if you don't like to borrow money, which I never like to borrow money, so I was always coming up with more ideas than I had money. So I had to sell whatever I liked least to buy something new that just was compelling to me. And for a long time, I was in that mode. And now our problem is we have more money than ideas.
When listening, we need to recognize Buffett is in a very unique situation. He now has more money than large attractive opportunities. We, on the other hand, should relate more to his advice on working with smaller amounts of capital.
In terms of our wholly owned businesses, we're not going to sell no matter how much anybody offers us for them. I mean, if somebody offers us 3 times what something is worth at See's Candy, the Buffalo News, Borsheim's, whatever it may be, we're not going to sell it. I may be wrong in having that approach. More and more, with certain stocks, we've got that approach. Now, if we were chronically short of funds and had all kinds of opportunities coming, we might have a somewhat different approach. But our inclination is not to sell things unless we get really discouraged perhaps with the management, or we think the economic characteristics of the business change in a big way. I mean, and that happens. So, but we're not going to sell simply because it looks too high.
Best thing to do is buy a stock that you don't ever want to sell. I mean, that's what we're trying to do. Sometimes if we need money to move to another sector, like we did last year, we will trim from some holdings, but that doesn't mean we're negative on those businesses at all. I mean, we think they're wonderful businesses or we wouldn't own them. And we would sell, if we needed money for other things. The Geico stock that I bought in 1951, I sold in 1952. It was, went on to be worth 100 or more times before the 1976 problems, 100 or more times what I'd paid. But I didn't have the money to do something else. So you sell if you need money for something else. You may sell if you believe that valuations between different kinds of markets are somewhat out of whack. And we have done a little trimming last year in that matter. But that could well be a mistake. I mean, the real thing to do with a great business is just hang on for dear life. Charlie?
Yes, but the sales that do happen, the ideal way is when you found something you like immensely better. Isn't that obvious? That's the ideal way to sell.
Let's go over the main points. Charlie put it very simply. The time to sell is when you find a better opportunity. This is especially true when you're working with limited sums of money. Other reasons to sell is if you think a company is grossly overvalued or there are negative changes in the business. This can be poor management, loss of competitive advantages, or lowered earning potential. So why did I sell the 3 positions from earlier? I had other stocks I wanted to buy, which were a better relative value. Welltower had already recovered significantly and now was trading at a very high earnings multiple. I thought they would see very limited gains over the next few years from the current price. Kraft Heinz has also seen large gains from my purchase, and the business is still in a multi-year debt reduction process. Pfizer was a little different. It was already pretty lowly valued, but I moved the money into Walgreens instead. I felt I understood their business better and liked the consumer-oriented side of healthcare. There's less worry about developing future drugs, patents expiring, etc. Going forward, I have a more refined selling strategy. I want to build core positions in high-quality companies that I can hold for long periods of time. When a business like this is at a good price, I want to make sure that I can invest heavily. For example, when I look back to 2020, I think the 2 best investments that I identified were Disney and ExxonMobil. I bought a good amount, but looking back, I should have concentrated much heavier. So in this type of scenario, I will sell out of my lower conviction stocks to build up a core holding. What I did recently, and I think this is a good thought experiment for people to try, is I broke down my portfolio into categories. I have my core or elite holdings. This is based purely on the quality of the company, things like their future growth ability and sustainable competitive advantages. These are companies like Apple, Microsoft, Disney, 3M, PepsiCo, etc. Core companies I will not sell unless their situation radically changes. Then I progressively have categories for lower quality and shorter time horizon positions. These categories and the companies in them are subject to change over time. The main goal of this exercise is to help prepare for the scenario I mentioned earlier. Thank you for watching Dividend Data. I'd greatly appreciate it if you could leave a like and subscribe to the channel. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. Also, you can follow me on Instagram at Dividend Data. You can support the channel over on Patreon, where you can gain access to a community Discord server. The link is in the description. Please leave a comment below, and thank you for watching.